The title of my presentation today is Investing in SaaS Business Models. So let's get started. So first of all, I have a quick disclaimer. So as Tina mentioned, I work for the Rivemont MicroCap Fund. This presentation is only for informational purposes. This is not investment advice or recommendations. And we might own some of the companies that I will mention during the presentation. So first of all, Rivemont is, as Tina mentioned, a portfolio management firm. We have 92 million of assets under management, and most of it is in traditional mandates of diversified stocks and bonds portfolios. And we also have three funds. One is the Alpha Fund, which is a long-short hedge fund. The second is a crypto fund investing in Bitcoin and other major cryptocurrencies. And the third one is the MicroCap Fund, on which I work exclusively. So a little bit about myself. Actually, Tina again did a great intro. So I've been investing since 2014 in the microcap sector in Canada. I started basically with no finance experience. I didn't work in the industry. I didn't study in finance. I just decided to start investing by myself, and by reading books, by attending conferences, by speaking with other smart investors. And eventually I figured out a winning strategy. It took me, I would say, about 2 years of trial and error to really find the right formula, I would say. And in parallel, I was blogging on Espace MicroCaps, sharing some things that I was learning along the way, and also investment ideas. So quick snapshot about the fund as of the end of last month. So we had 16 million of assets under management, 28% annualized return since inception. We had 31 positions, which is a bit higher than we typically like. But nonetheless, the fund is quite concentrated at the top. So the top 5 holdings make up about 40% of the portfolio. And even if we look at the top 15, it's about 75%. And on the right, you can see the sector allocations. And 60% of the fund is invested in technology. So technology is a bit larger than only like the SaaS business model, but I would say most of it is in SaaS. So it's something I think we know well and are comfortable with. So quick word about our investment strategy. So what we look for, first of all, we like revenue growth. So we want to see ideally over 25% year-over-year revenue growth. It's not mandatory. We'll look at companies that don't meet this criteria, but it's something we like to see, and obviously the higher the better. We want to see positive cash flows or a clear path to it. And when I say a clear path to it, it can be either a company that is growing and nearing profitability, or a company that's they decided that they don't want to be profitable right now. So for example, a lot of SaaS companies are reinvesting their capital to grow faster, but they could be profitable if they wanted to. So this is something we're okay with. The third thing is a scalable business model. And again, technology companies fit that criteria very well. The fourth one is we want to find them small and undiscovered. So we like to be the first institutional investor in a company. So or one of the first. We want to find them so small that there's a lot of inefficiencies, that maybe retail investors don't really understand the business model properly, or that we want to find something that's misunderstood about the company, and usually we find that in the smallest companies we can find on the Canadian markets. Then we want to see some form of competitive advantage, and I say some form because typically microcap companies don't have like very strong moat. The strong moats, you see that in larger companies, and that's why they became large. Microcaps typically have developing competitive advantages, or maybe they have a moat in a very specific niche of the market that's probably small. But we want to see something that can develop and become a wider moat over time. And then the last thing we want to see is an outstanding management team. So we always speak with management before we invest in a company. We want to make sure that the people at the helm know what they're doing. So a little bit about the SaaS business model for those who might not be familiar. So what's the SaaS model? Well, I outline here the differences between software as a service, or SaaS, and traditional software. So the first thing is that SaaS is hosted in the cloud. So there's no need for costly infrastructure for the customers. It's easy to deploy, it's fast, and it's scalable, compared to traditional software where it's hosted on-premise, needs more IT budgets, hardware, all that stuff. Then software as a service is sold on a monthly recurring fee or annual recurring fee, typically, and there are minimal upfront fees to the customers. So typically the upfront fees will be like customization or implementation. And traditional software, on the other hand, has large upfront fees. You need to buy a big license upfront, and then there are minimal recurring fees. And typically it's only like support or maintenance. In SaaS, the customers don't own the software, so they need to pay every month or every year to get access to the software. So that makes for sticky revenues, compared to traditional software where customers own they buy a license and they can use it as long as they want. And finally, in SaaS, the revenues are predictable. Compared to traditional software where it can be very lumpy because you have those big license sales that can be a bit unpredictable sometimes. Now, what about a recession? I think a lot of people right now might think that the stock market is overvalued or expensive or in a bubble, or you'll hear all sorts of stuff that probably the market is expensive right now. So I thought it was interesting to highlight a study that SaaS Capital did a few years ago, and they looked at 15 public SaaS companies during the Great Recession of 2008-2009. And you can see on the chart, the gray zone in the middle is the recession. So what happened to these SaaS public companies? Well, their growth rate got down from about 40% to about 10%, which shows that they still kept growing during the recession. So it was slower, but still they kept growing. And the red line at the bottom is the average operating income or loss as a percentage of revenue, and you can see they had on average about a 10% net loss margin before the recession, and at the end of the recession they were almost break even, and they reached break even shortly after. So what that shows is that the SaaS model is very resilient during stressful economic times, and also those companies can dial down their marketing expenses or growth expenses during times of uncertainty to get back to cash flow break even and making sure they have enough resources to get through the crisis. So I think that it's a great business model to be invested in, even though the market might be expensive and we might have a recession or a market correction eventually. So I want to share a few SaaS metrics to look for. Those are some things I look for, and it's not like a rule that you need to hit those metrics, but I encourage people to Google them, learn about these metrics, and learn how to use them. The first is revenue growth. So I mentioned that previously, we want to see strong revenue growth. The second one is we want to see low churn. We want companies that retain their customers, that have a high retention rate. So churn below 10% is what we want to see, and ideally way lower than that. The third one is a high LTV to CAC ratio. So LTV is the lifetime value of a customer, and the CAC is the customer acquisition cost. So we want to know how much does the company spend to acquire a customer, and then how much is this customer worth over its lifetime. And we want to see obviously a higher ratio we want the LTV to be higher than the CAC, otherwise the company would be destroying value. And so again, this ratio we want to see the higher the better, and 3-to-1 is considered pretty good. And the last one is a quick CAC payback. So for example, for a company that acquires new customers for $1,000, and the customers pay on average $100 per month. So it takes 10 months to get the CAC paid back. So that's pretty good. We want to see under 12 months for the company to get a payback on their customer acquisition costs. So in summary, why we like the business model, the SaaS business model, first of all, the scalability. Those businesses are highly scalable. They don't need to add a lot of infrastructure or a lot of costs to scale, and typically they have high margins, and also the operating leverage. So they can leverage their fixed cost base and generate meaningful profits for every additional dollars of revenue. The second one is that they are often mission critical and sticky. So I'm thinking about, for example, enterprise software. Those companies that sell enterprise software, the software typically gets very embedded in the customer's business processes. So it gets very hard for the customers to change providers or to just stop using the software. So again, it makes for very predictable and sticky revenues. And the last one, it's that it's easier to model and estimate intrinsic value. So when revenues are recurring, it's easy to model a few years in the future and try to like, for example, if you're doing a discounted cash flow model, well, it's easier to do that compared to companies with more lumpy revenues. So that's it for my brief presentation, and I think we have time for Q&A, so I'd be happy to answer any questions.
Yeah, thanks so much. So I just want to remind the audience, if they do have any questions that they would like answered, there's a Q&A box at the bottom of their screen. They can just type their question in there. I definitely wanted to kick it off. I had a few questions. So it looks like you've said you're invested in a number of the companies that are going to be presenting here today. So at what point do you look to get involved with these stories? Is there something that kind of acts as a trigger point for you guys, or?
Yeah, well, typically what I want to do is to invest at the, let's call it the inflection point. So like young SaaS companies, typically in the early years, will need to burn a lot of money to do some R&D, build their product, get sales and marketing going, and try to increase their revenue. So they have to burn money initially, but at some point they reach enough scale that they can they could become cash flow break even or profitable if they wanted to. But some of them will decide to raise more money and reinvest in their growth and spend more in sales and marketing and build a better product. So typically, I try to get involved at the point where it's like the last financing that they absolutely have to do. So and going forward, they can raise if the price is good, if the market conditions are good.
It seems like in terms of some of the companies that we look at, well, you mentioned the inflection point. Often the contract sizes are quite small, so it takes a long time to build that momentum. So do you have any thoughts in terms of contract sizes and how these companies are able to scale and turn that into strong revenue numbers?
Yeah, well, it's not the contract size is not I would say a typical metric or data point that I will look at to make an investment decision, but I tend to prefer companies that are selling B2B or like enterprise software. I think those companies have more sticky revenues, and also the contract sizes are bigger. So I feel like I feel like it's a better model. I've seen more companies have success this way, and in terms of predicting their ability to scale, I would say I look at the track record. I look at the last few years or last few quarters, and I try to. I want to see them executing already before I invest.
So a few audience Q&A have come in that I'm just going to read the first one. So do you exclusively invest in Canadian listed companies, and how are SaaS multiples in Canada valued relative to their US peers?
Yeah, so I invest only in Canadian companies. The fund has a North American mandate, so we could invest in the US, but it's just a matter of focus for us. The Canadian market is what I know best, and I think having a good network to find opportunities is very important. So my network is in Canada. So I mean, at some point I could develop a network and an expertise in the US, but I don't have it right now. In terms of multiples, I can't answer that one. I would guess that probably US companies have higher multiples than in Canada, but since I'm not very familiar with the US market, I can't really answer. I can't provide a good answer to that one.
I think VitalHub's got a chart on some of the multiples as well, so I'll make Dan and Brian answer that question.
And then a second audience questions. So they're just asking you about the liquidity that's in the microcap market, and how difficult is it to sell some of these positions that you have?
It can be challenging to sell. It can be challenging to buy as well. So a big part of our strategy is to participate in financings because it allows us to get the liquidity we need. We can buy a full position into a financing without buying in the market and moving the stock price. So that's been a good way for us to establish positions. And then if we are wrong on an investment thesis and we need to sell, well, can be very painful sometimes when the liquidity is not there. So I think what's most important is to be right on the investment thesis. And if you're right, well, you don't really need to worry about the liquidity.
Yeah, we were talking about earlier in terms of timing of when to sell. I was bragging about my 20% returns since last year, but I know you've been invested in a number of positions that have been multi-baggers. So when are you looking to decide when to sell, and what's your exit strategy on some of these names? Yeah, sure.
So typically there's I would say there is kind of a discovery cycle in microcaps where when you find them very small, they have no liquidity, no analyst coverage, no institutional investors. And at some point, if you're right on the investment thesis and the company executes and they grow and they become more profitable, at some point their market cap will increase, and some analysts will start covering the stock. You will have more institutional investors getting involved, and the liquidity will improve. So I would say it's more a matter of size when they get too big. So our focus is under 300 million market cap in Canada. So when they get to the top of that range, in general, we think we can find better opportunities in the smaller ones. New ones we find that are smaller and more undiscovered. So that would be when we consider selling, is when we just find something better.
Okay, I think we have time for one more question. So when you're looking at companies in this space, and there's organic growth and M&A growth, I guess, how do you think about both sides, and do you have a preference for one over the other?
Yeah, I own both organic growth stories and M&A stories, so I like both. I would say if I had a choice, I would probably go with organic, because M&A, you need to find the right targets, you need to pay the right multiples, and sometimes it's a bit out of your control if the markets get very hot and the multiples increase. It can be challenging to execute an M&A strategy, or sometimes the markets are not there to provide the capital that you need to execute on an M&A strategy. So I would say maybe there are a bit more risks in an M&A strategy, but that being said, in some industries it makes a lot of sense. For example, I'll just mention one, Accrue, that's presenting at the end of the day today. It's our largest position in the fund, and it's an M&A story, and I think they have a great strategy to acquire these small companies in the payment and loyalty space. So yeah, I mean, this is an industry that it makes sense to do M&A.